Welcome to the Real Joe Show. On this episode, we are talking with Michael Martin from Fairway Independent Mortgage. You're gonna want to listen to this if you're doing real estate in the North Carolina Triangle area. He has the ear of agents. He's talking to them every day, all day long, and he's gonna have some insight that you're gonna want to know. So let's go, Michael.
Hey, Joe. Thanks so much for having me.
Yeah, it's great. Thanks for coming on again. We did this probably about a year ago, and a lot has changed since then. And so, what is going on? What are you hearing from the agents in the area?
Yeah, so I call a lot of real estate agents, right? My main job is really staying in front of and active and listening to real estate agents and their needs and desires. As a loan officer here in the Triangle for 21 years, it's really, really important that we understand a real estate agent's needs. And because our business feeds off of the real estate agent's business, right? Without somebody selling or buying a home, then we don't get a loan. And so because of that, I ask lots of questions. And the market today, right here we are, May 19th of 2023. And we've had an interesting last several years, right? And really everything kind of started about this time last year, where interest rates went from, the mid threes or even low threes, even some ones in the twos, right? And then started heading towards the peak in the summer of mid sevens. Rates got a little bit better, then they went worse again back in October, up to the mid sevens again, and then they got better again. We expected the market to be by now, right, with the folks that I follow about what's happening with inflation and interest rates. We expected rates to start coming down. Unfortunately, the pattern is not in our favor. Rates have been heading upward for the last week or so, again, heading back towards 7%. Now, when I talk to agents, real estate agents in our market, I actually just came back from a conference that I was at last week. So I was talking with top producing real estate agents and mortgage lenders all over the country. I think there's about 650 people there. And everybody's experiencing something similar, although there are some differences in certain markets. Like Northern California is absolutely brutal. I talked to a major top producing loan officer in that market, and he said the entire county.
What's that?
Sorry, my screen went. He said the entire county he was in had 22 sales last month.
22. Is that due to lack of inventory, or is it?
It's due to, the California market has been different anyway, right? And it may not have been last month, but it was one of the most recent months around. He said their entire county had 22 sales. And so, he had 4 of them. And so his coach told him he needed to get all 22 of them because he's normally closing 40 loans a month. Yeah. So interesting, right? So that particular area, and I've heard it from other places, there's just not sales. Like people are moving away from those areas too. So I think that's part of the issues on the buy side. There's just not as many people buying. But every market's a little bit different. The folks here in the Triangle that I'm talking to overall are telling me they're having, and I've got some exceptions to the rule, but overall are telling me that their buyer leads have dried up quite a bit. Some of our great partners are telling us, Michael, I want to get people to you. I just don't have anyone. We've been on the phones, making calls, and buyers are just hesitant, right? These higher interest rates are scared. Now, the good thing is the buyers that are out there are not afraid of the interest rates where they are right now, right? They're committed buyers, and they're generally, you can get them under contract. Now, of course, we have pretty limited inventory at the moment. I did look in the MLS recently, actually yesterday. We look at what's active, all active, and we look at pending, and of course we combine the two because that's really the entire market, right? What's actually on for sale, whether it's under, it's not sold yet, right? It's pending, and so we look at those numbers every single week, so we can see trends, and it's been trending downward from pendings as well as listings, all listings. But last week, actually, or as of yesterday, the numbers were actually up a little bit. So hopefully that's a good sign.
Yeah.
I am hearing some agents, locally telling me, that they have seen recently some new leads pop up where they've been slower over the last month or so. Yeah, I think there are people that are also getting comfortable as much as they don't want to. They're getting comfortable with rates being in the sixes.
Right.
Right. And we know
historically it's not that bad, right?
That's right. Yeah. In reality, a rate, the average rate over the last 50 years is 7.4%. Right. So that's the average. So we're, below the average. You would think that'd be good, but it's, people have short memories too, right? When they were shopping a year or so ago and they have rates in the threes, it's really, really difficult because your budget, you're mentally prepared for a payment of this, and now it's going to go to this.
What are some of the solutions that you're talking to agents about, how to get people engaged in buying?
Well, there's a couple different ways to do it. At the end of the day, right, a real estate agent's job and a mortgage lender's job is to sell them on purchasing a home or selling a home and getting a mortgage loan, right? But sometimes we have to listen, like really, truly listen, because most cases, I think it does make sense for people if they need a home, especially if they're renting. It really makes sense for them to buy sooner rather than later, right? The one thing we know for sure that's going to happen is when interest rates come down, you're going to see that the market, the buyers are going to come back in droves, right? And so that's just going to cause, even with the smaller amount of transactions that are occurring right now, most of them are multiple offer. I just talked to a listing agent a half hour ago because I've got a buyer making an offer on her property. I happen to know the listing agent, so I called her, had a conversation with her, and she's like, "Yeah, Michael, your offer is pretty good. I already told the buyer's agent it's pretty good. The due diligence number is great, but we have a ton of activity on this particular property, and it just hit the market yesterday. We're not going to accept any offers until Sunday, right?" Which makes sense. I get it. Right. But she's saying, we're expecting multiple offers, right? And this particular property is in Goldsboro. It's not, it's not Raleigh, right?
It's not prime time.
And so, but they're expecting multiple offers. And so, you never know whether they'll get them or not. But the reality is most of the buyers that we're seeing getting under contract are competing with multiple offers. Yeah. And so you're going to have good due diligence, strong due diligence, right? And this is why rates are high, or considerably high, at least comparatively, right? So as rates come down, as buyers, get more and more, more buyers are back out because the rates are better, because it makes the payment better. The competitive offer situation is going to get worse and worse and worse. And the first time home buyer without cash is going to be in trouble, right? They're just not going to be able to compete because most first time home buyers don't have $20,000, $30,000, $40,000 for due diligence, right? Or to cover a potential, appraisal gap, those kinds of things. So to answer your question, what are we doing to help move the needle? Frankly, we're doing our best. And I think a lot of us are struggling with it, right? Because the reality is, until somebody's fully motivated, and that's what we also have to do, is discover what their real motivation is. Right. What is their pain? And the longer people continue to rent or continue to stay in a home that they're in, that they don't like, right? Whether maybe they bought in 2020, or maybe they bought, they didn't just have to buy in 2020. Maybe they bought in 2017, but they refinanced in 2021.
That's right.
To a low rate. And so that the sting of that. Now, I've heard a lot of this, magical number of 5.5%, right? I've read all these articles that say if we get to 5.5% for 30-year fixed loans, then even though that's higher than the 3.5% or 4% that maybe somebody's sitting on, it's not too high where they can't manage that pain.
Right.
Versus the 6.5 to 7%, that's just too high. They're not going to look at it. So I think one of the other things is trying, as agents and lenders, trying to find people that have higher motivation. So how do you do that? Well, one of the things that we're continuing to go after right now, and this is not to be, take advantage of any situation, but these people need help. Folks that are going through a divorce, right? Yeah. They have to either refinance or purchase a home or sell a home. Those folks have a very strong motivation. And the reality is over 50% of married people, unfortunately, end up in divorce. And so that's going to happen. I'm talking to several different folks right now that are in that situation. Estate attorneys, right? They deal with people's estates, and they have to do something with that property, regardless of what is going on with interest rates. And so those are folks, I think, that make a lot of sense to build relationships with, pour into, and and it will help you forever, not just now, but it certainly is a good place right now. But discovering that motivation.
Right. And that's huge. And those are really good. Like you said, it's a negative situation, but it's a have to. It's a have to situation when people need to move. So they need to buy, they need to sell, they need to move on. And that's ideal. What about the people that really they want to do something and they were looking last year and now they're putting the brakes on. They're about to re-sign up on their lease.
Mm-hmm.
And do you have any economic numbers to talk about how foolish that really is and what the true cost of that is?
I don't have an exact example to share with you. It's certainly something we could prepare, but I don't have those numbers in front of me. I should have for this conversation. But what I can tell you, right, is when you look at the cost of renting versus buying, right, we have some really unique calculators that can show you this data just by plugging in. I'm renting, I'm paying this, my payment on a mortgage would be this. What does that look like over time? And almost always, not always, but almost always, if you're planning on being, planted or, settled for 2 years or more, then buying a home is always going to win. Almost always, right?
And it's a case by case. And my asking is, do you have numbers? It's gonna matter. Every individual is going to have a different payment plan. They're going to have different costs and different aspirations to what they want to get into. So it's going to vary. But you do have a formula. If you can meet with somebody, say, hey, this is what it looks like. You're going to be paying rent. By the time you go to buy a year from now or 2 years from now, it's going to be this much more expensive to get in there.
Exactly.
And it's going to negate. You're going to lose all this money for a down payment. You're not going to have equity.
Yeah, it probably will end up costing them, right? Because again, it's the same situation. One of the strategies we had last year, and we did it even in the fall as well as the summer, was this whole buy down, right? You've got two ways to buy down an interest rate, which helps your overall payment, right? The first one is, of course, the permanent buy down. So you pay points and you get a lower rate. Usually the break even for that is 6 to 7 years, right? So you're paying extra fees at closing. 1 point is equal to 1% of the loan amount. So if it's a $500,000 loan, that'd be $5,000 more at closing. It's going to give you a payment, a lower payment of X based on maybe instead of a 6.5, you want a 6 1/4 or 6 1/8. And so from there, you can do the math, dividing what your monthly savings is into the upfront cost, and there's a break even point. It's typically somewhere around 6 or 7 years. And so right now, some of them are a little bit closer to 5, but the reality is, most everybody expects rates to be back into the 5s, maybe even the 4s in the next couple of years. So everybody's going to be refinancing those loans, no matter whether you got 6 1/8 or 7%, right? You're going to refinance that when rates drop into the 4s or 5s. And so I'm not a real big fan of paying points, permanent points right now. I just don't think it makes a lot of sense. Not in every situation, but in most. The great thing about the temporary buy down, that's the other option, is that it's an X amount of money. Basically what we do is we determine, so there's a 1-0 buy down and a 2-1 buy down. There's even a 3-2-1 buy down. But what happens is if it's a 2-1 buy down, if the rate's 6.5 today for a 30-year note rate, then you would get 4.5% the first year, 5.5% the second year. And then from year 3 and on, you'd go to that 6.5%, expecting to refinance it in that period of time and get a lower rate permanently. Now, that works really well, right? The cost on that varies, but it's basically the differences in what your payments are is what the upfront cost is. And it doesn't make sense necessarily as a buyer to do that because you're just prepaying your part of your payment.
Right.
But you can get the seller to pay for that. In fact, it generally works way better. And this is where I think a lot of real estate agents get it wrong. When you're negotiating with a seller, you're generally better off in like 90% of the cases to instead of negotiating a lower price, to negotiate some closing costs by the seller to cover this buy down. And it gives the buyer way more relief in the short term, right? Because sometimes depending on the loan amount, $450,000, $500,000 loan amount, it can save them $500, $600 a month for the first year. And then roughly half that the second year.
Now, this has to come with a caveat that the price is going to, the monthly payment is going to go up. If the rates don't, they need to be able to pay that monthly.
Yeah, that's important too, Joe. So we have to qualify them on the note rate, not the discounted rate. right? Because we don't want to put somebody in a situation that all of a sudden they can't make their mortgage payments, and they need to be very well aware of that. Right? In case something happened where interest rates don't come down like everyone in the world is predicting them to do, yes, they can afford that. Now, the cool thing about the temporary buy down, right? On the permanent buy down, you pay the $5,000 or maybe you pay 2 points, and it's $10,000 to get maybe even a little bit more, a little better rate for the long term. That money is gone. Once you go to closing, it's you pay for it at closing and it's gone. So if you refinance because rates drop even more, then that money is just wasted, totally gone. With a permanent buy down, if whatever's money that hasn't been used. So what happens is all that extra interest that's calculated, or not interest, but the shortage of the payment that's calculated is put into an escrow account. The servicer of the mortgage basically goes in and taps into that and subsidizes the payment. So Fannie and Freddie are collecting the full payment at 6.5%, whatever that note rate was originally. It's just they're grabbing a little bit of piece from this escrow account each month to make up the difference. When you go to refinance this or pay this loan off in any way, whatever money's left in that escrow account goes towards the principal balance, right? There's a couple of ways they can manage it, but typically I think it goes towards the principal balance. So you, as the buyer or the owner of that property, now get full credit for that money versus it disappearing like a permanent buy down. And in many cases, you can just pay for the darn refinance that you're going to do, because the refinance is going to have costs too. The biggest challenge, and the reason we've done these last summer and last fall, and frankly not as often right now, is when you're competing, like every buyer that I have is right now, it's really hard to ask anything for a seller pay closing costs, right? So it's really tough to make that happen.
Okay, is that why it's seasonal? Because in the fall it was a softer market for.
That's correct. Yeah. So I mean, you got to think, if I needed to utilize this, if I wanted to utilize this. By the way, this is another. This is not like anything genius, right? If I'm an investor and I'm looking for a deal, first thing I'm doing is I'd have my agent send me everything that's been on the market for 30 days or more, right? Like, because you can negotiate with those folks way better than you can negotiate something that's coming on the market this weekend. And so, right, same thing with these. If you needed a seller, buy down, then you can certainly have a much better chance of making that happen if the house has been on the market for a long period of time. And 30 days is a long period of time, right?
Isn't it? Yeah. So one of the things that is happening, and it is out there is some long-standing inventory. It happens to be part of the iBuyer problem, where they purchase too high and they're on the market for too much money, and they're not in the greatest of shape. They're not in the best condition. Homeowners that are traditionally selling their home, they're typically, if it's a good agent and they listen to their agent, they're going to stage it, they're going to prep it, it's going to look nice, it's going to sell for the highest, fastest price, right? With these others, we get into situations where there's some work that needs to be done. If we have a first-time home buyer, or maybe a repeat buyer, somebody that doesn't have a lot of the funds to go in and refurbish this, what options do they have? Because there's inventory out there that people are not looking at. They don't have, a lot of buyers out there have the HGTV eyes, and they want everything to be perfect when they step in. And I get that. If there's opportunity out there for those who are willing to put a little grit into it, how do they do that? What kind of loan programs, what kind of opportunities are there?
Yeah, there's several different types of options out there. I mean, when we just naturally, we think of renovation financing, right? So there's a few different options. You've got conventional refinancing. You've got a refinance option for FHA, the 203K program. And then you've got VA renovation. So we've got, multiple options out there where you can utilize different loan programs for renovation. And so it's really understanding the type of renovation. I'll give you an example. We just closed one last month. I actually stopped by there 2 weeks ago. It was really cool to see the property. It's a property inside the Beltline in Raleigh. The house, some of you guys may have heard the story, but the house had an explosion. The people had a brand new home. People just moved into the house within maybe a month or so. And there was a gas leak underneath the driveway, but it ended up feeding gas underneath the home. And so apparently there was just gas just sitting underneath this house in the crawl space. Wow. And there was an issue with the HVAC, and the guy went to go underneath the house to work on it. He lit something up, a torch, boom, a gigantic explosion. Weirdly, nothing burned. There is not I looked under this house. It looks like it's brand new, but it just causes major impact, all right, from the explosion. and it knocked the house off the foundation.
Wow.
So brand new home. The people, I don't know the whole story, but my understanding is the sellers, they were in the house when it happened. There's some young kids involved. Fortunately, I don't think anybody got hurt, but it spooked them. And so they said they got their insurance money and checked out. And so they put the house on the market, sold it as is. Our buyer's agent found the property. We had the perfect buyer in this circumstance. She actually was a project manager for construction companies for years, so she knew a lot of the details here, right? She was not afraid of this type of project. The house is gorgeous. I mean, it really is gorgeous, just like a brand new home. And so she ended up buying the property. I don't know, somewhere, I'm going to call it $700,000. I think she was putting in 150 in total renovations. She had to go. I went by the house last week, the week after, or week before, and she had the house leveled, not as in like torn down, but leveled, because it was not level. It was not sitting on the foundation, right? So they did, there's hydraulics underneath the house getting it all leveled. Pretty wild. And so, she put about $150K roughly into it. So maybe she's got $850 total and appraised over $1 million.
Nice.
That's one type of project. So we used a renovation loan for that. By the way, we closed that in 19 days. Like, unbelievable. I couldn't believe it.
19 days with a renovation loan. That sounds pretty incredible.
Yes.
Because they're typically, you need some documentation, you need contractors.
Oh yeah, we gotta get contractor approval. It takes a lot of work. Our team really pulled this miracle off. We closed it on time. Now, I'll tell you, without telling you any names, I'll tell you the real story about it. We were trying to pre-approve the buyer. She was moving here from out of town. We were trying to pre-approve the buyer, and she was missing a very important piece of documentation for her income, and we just couldn't get her pre-approved. So we wouldn't write a pre-approval letter yet, and she found this house. She was worried that it was going to, get swept up by somebody else. They ended up getting her under contract without telling us. She was looking, I think, at some hard money financing options in the meantime, just in case we couldn't pull it through. And so the house went under contract with about a 45-day close, but we didn't know it was under contract till like 2 weeks after it was under contract. So the agent partner of ours, who we've worked with for quite a while, in fact, I helped him on his personal house when he moved here from out of town. He sends us the contract. He's like, sorry, I haven't given this to you, but we weren't 100% sure what's going on. Here's a close date. It's less than 30 days. And, by the time we got it all worked out and submitted it, got it pre-approved, got it done. And we'd gotten the documentation, fortunately, by then that we needed from her, and closed it in 19 days. I would not recommend doing every renovation loan in 19 days. I can tell you that. It takes a lot. It takes the right buyer, and she was the right buyer for that particular situation. But going back to your other question, Joe, that's a great way right now, if you're a buyer, whether you're an investor, because we can do renovation loans on investment properties too, whether you're an investor or trying to buy a primary residence. If you really want a deal, if that's something you're looking for in a tough market where it's really hard, that's exactly where you go. Is you go find properties that need some work, and we can add pools. You can do amazing things to renovation, or you could just do carpet and paint. Like I always tell everybody, think about this. I just did a lunch and learn we hosted here at my office, and I think we had 25 agents here, and I just want you to realize there's more inventory out there than you're thinking, because like you said, they're not looking at this stuff, right? You got to pull the onion back. If you're pre-approved for a $400,000 conventional mortgage, then you're also automatically pre-approved for a $400,000 renovation loan, which means you maybe find a property that's $300,000 and you do $100,000 worth of renovation work. Maybe it's $350,000 and you do $50,000, right? You can do as much or as little as you want, as long as there's a big caveat, right? It does have to appraise. Now, interesting thing on the FHA loan, it doesn't have to appraise. It has to appraise for something, but not what you think it does. There's a backward formula. We get basically a 10% to play with. That's the best way to explain it, without going to the details of the calculator. So we've got a lot more room with the FHA if we go that route.
That's surprising and very interesting.
Yeah. So
now is that a FHA in general, or just on the construction?
Just on the renovation loan.
Renovation.
Yeah, just on the renovation loan. So yeah, FHA in general is not that way. So there's definitely some things to go out there. And this is what I tell people: listen, a renovation loan is not for every single person by any means, but it is for a lot more people than you think so. right? Because if you have that buyer who really wants to buy a house, maybe they're in a crunch time. Now, crunch time might not be the best one either, because generally we want 30 to 45 days or so for a renovation loan because there's just so many moving parts. I just think people have heard in most lenders, and I'll be frank and tell you, I was one of them the first couple times I did a renovation loan. Most lenders don't do very many renovation loans. They don't understand the product. They try, put a round peg in a square hole, and it gets really ugly really fast. Right. I learned how to do renovation loans in 2010, 11, 12, and 13 when we had so much inventory, right, that was sitting out there that was either short sale or foreclosure. And some of these homes you couldn't finance without a renovation loan. And so that was a niche that I decided to get into and became a renovation loan expert then. Again, I had first few deals, it's not a flip loan. That's what a lot of people try to utilize. It's not that. You can't do it for that. But there's some really good opportunities with that loan. Yeah, the interest rate's probably a quarter point higher than a traditional loan too. No big deal. Everybody's going to refinance in a year or so anyway. Let's
right.
get you taken care of, and then we can refinance to a conventional regular loan anyway.
Let's switch gears real quick, because we're running into the end of the show.
Sure.
And closing a deal in 19 days, as complicated as a renovation loan, the communication from your office, it's got to be tight as it could be. How do you manage it? I know you belong to, you're being coached by the core, mm-hmm. which is a phenomenal organization. And I know that helps with you building a team. Talk to me about you and your team and how you can handle that type of transaction and get it all done so quickly.
Well, again, to do that for a renovation loan, it definitely takes everybody working together, right? That one had the right buyer, the right agent, and then Nicole and my team just was phenomenal to make sure we got it all done. But we've been in the core now as a level 3 student for 7 years. We have summits every 6 months. So I just got back last week. I was in San Antonio, but we're coached every other week too, right? And every time you go to a summit, you get 150 ideas, right? You can't implement 150 things. So you pick 10 things, right? So I've got a list of 10 things I'm working on right now that we're going to implement over the next 2 to 3 months. And so, and then I'll go in 6 months again, right? And we'll get another 10 things. But I've been doing this. We have a summit. So if it's 7 years of coaching, that's 14, summits. So you can imagine, 10 times 4 times 14 is 140 things that we've got implemented into our systems that just make that process go easier. A big part of all this, to be frank with you, is a loan officer that's not afraid to have a tough conversation with the clients, right? Some loan officers, especially newer ones, I'm sure I did some of this when I was newer too, is you want the client to say yes, and you'll tell them almost anything, get them to say yes. Yeah. And so you overpromise and then underdeliver, and then you have a bad experience. In my business, I can't afford to have a bad experience. We've got over 600 5-star reviews, and we wanted that to keep going to 1,000 and 2,000 and 5,000. And so we truly want to earn a 5-star. I don't want somebody to give me a 5-star review, right? I want the client to be absolutely thrilled. Yesterday, I was making calls to past clients. Thursdays, that's what we do, is we call our past clients. We've got a formula on how we do it. And it's just so interesting. I was calling clients from 2 years ago. I couldn't believe, first of all, how many of them picked up. I have to make these calls and I want to connect with them, but I had 29 calls to make. And I was like, if they all pick up, I'm never going to get these done. I only got 13 made, but 10 of them picked up the phone, and I did their loan 2 years ago, and they were like all super happy. My assistant was sitting in the room with me as I'm making the call. She's like, man, every one of it, she just joined our team. So she doesn't know how our systems work entirely. She's like, every one of your clients really loved working with you. I'm like, I know it's, typically the mortgage guy is not somebody they're really thrilled about or in the process of. So I think answering your question, it's, you got to have systems. You've got to set proper expectations with all parties, even if they don't want to hear it. Like, that's the most important thing. I know so many guys that are in the mortgage business, several locally, that are really good people, but they are horrible at communicating bad news fast, right? And everything then blows up, and and then it just set on repeat. You see it over and over and over again. For us, it's about getting the bad information fast. But if you set them up with success and you fully explain all these things that can happen and how we can avoid them to happen, then you can generally avoid all that from going south anyway.
And you mentioned that 10 people picked up out of the 13 calls, which I wish I had that ratio. That the reality is, it's not the first time they heard from you in 2 years.
Sure.
You're pretty consistently marketing to them, as I understand it, correct?
Well, and they get my videos, they get my HomeBot report monthly, and so I ask them too when I'm talking to them, hey, just out of curiosity, you get my videos? Like, oh my gosh, yeah. I don't watch them all, but I try to watch them when I can, and and I'm like, do you get the HomeBot report? And most of them say yes. There's a couple of them say no, and I go look, and they don't even realize it. And so, the HomeBot report is just a monthly thing that really is great, gives them information. I think the open rate on that, Joe, I'm not sure if you're familiar with HomeBot, but it's an email. For those of you who don't know what it is, it's an email that you get once a month, or the client gets once a month, gives them the home value. That's why they look at it. But it gives them so much more information inside there. It tells them how much principal they paid, how much interest they paid. Does it make sense to refinance right now? Which, of course, 99% of them, it doesn't. But if they pay, extra principal, how fast they'll pay their loan off. It's got really unique tools in there. But the open rate's like 86%. 86 of the percent of people that get that email open it. So it's pretty cool.
Value of the home. It means lots of people.
That's right. It's like a financial statement for your home, not just your mortgage. That's really what it is about. So,
and you for the agents, you're not abandoning them. If they brought that client to you, you're connected.
Absolutely. In fact, I have my whole things, my pipeline report from the year that I'm making the calls up, right? So I've got up. So I always know who their buyer's agent was, and I'm always bringing the buyer's agent back into the conversation.
Great.
That I work a lot with Michael Turbot. So it's like, have you talked to, Michael recently, or have you been to, of course, nobody calls him Michael. Have you ever talked to Super Turb, recently?
Super Turb.
Of course, we work so closely that, we're a part of the events he does. He's a part of the events that I do in some cases. And so, we're bringing up his events when we're talking to them so we can get them to show up to a Super Bowl party or whatever it might be. Right. And so those are things I think it's so important to be engaged, to have conversations. I used to dread making my Tuesday update calls, mostly because I didn't do them. And so you dread something, but when you start doing them, then you have these great conversations. It's like, gosh, I can't believe I wasn't doing these forever. It just made so much more sense.
It's like going to the gym, right?
That's right.
You don't want to get out of bed and go to the gym, but when you're done, you feel good. It's picking up the phone, making the calls.
I think you're right. That's exactly right.
Good stuff. All right, Mike, we came up to the end of our show. I want to thank you again for coming on. Michael's number is right here, 919-612-9978. Give him a buzz, find him online. He's got great information. I've watched your videos that you send out. You're out there. You're making people feel good about the decisions they're making, and it's a pleasure getting to know you over the last year and a half or so. And I look forward to continue doing that.
Thanks so much, Joe, for having me. I really appreciate it. It has been an absolute blessing getting a chance to know you as well, and I appreciate our relationship.
Yeah, same here. All right, Michael. Peace out. Take care. Have fun. Be your best.